Okay, so it is now 11:02 and I'm going to kick off while we have other people joining us. So good morning to everybody, particularly Nigerians in Canada. And if you are joining us from elsewhere, good afternoon, good evening. You are welcome to our monthly community engagement session. What we're going to be discussing today has to do with mortgages, and we'll be learning from experts everything we need to know about obtaining a mortgage in Canada. Our objective for hosting this event is to help Nigerians in Canada take steps closer to their home ownership goals. My name is Nnamdi Nake, and on behalf of the Nigerian Canadian Association in the Greater Toronto area, I thank you for joining us today. We are quite excited to have you here, and also our experts are here, our mortgage experts are present. And before introducing them, I'd just like to do a bit of housekeeping to guide the session for today. First of all, it's been scheduled for an hour, and the expectation is that we'll end by 12 noon Eastern time. That's US and Canada. And that will be 6 p.m. if you're in Nigeria. So, however, if there are so many questions that come up, or if the need arises, we could maybe extend by about maybe 15 minutes, but we'll see how things go. Regardless of whether we need to extend the time or not, we're going to provide contact details of our experts so that you can follow up with them afterwards. This session is not intended to end here. So even after today, you can still connect with these experts, and ask as many questions as you want. It's going to be an interactive session, and you are encouraged to ask as many questions as you have. However, to ask your questions, please type it into the chat. When you type into the chat, your question will be read out. If time permits, what we're going to do is call on a few participants here and there to ask their questions directly. However, for you to ask your question, you must have typed it in the chat first. That is how we know you have a question. So to recap this piece about how we're going to make it interactive, all the questions coming from participants have to be typed in the chat. And from the chat, it will either be read or you will be invited to ask the experts directly. The last thing I want to speak about regarding how we'll run the session today has to do with keeping our microphones mute, just to facilitate a smooth conversation and to reduce interruptions. So having said all of that, I would like to thank you once more for joining us, and like to introduce our experts for today. So to introduce them, let me just share my screen. I think that will probably be the best way to go about it. Give me a moment. I hope my screen you can all see my screen. Okay, great. So the very first expert we're going to be meeting today, or who's joined us today, is Franklyn Ben-Awurum. Frank possesses over a decade of professional experience, delivering value and providing thought leadership to clients and stakeholders. As a licensed mortgage agent, his purpose is enriching lives through home ownership and enabling Nigerian immigrants in Canada to reach their full potential. Frank is results-oriented and focuses on finding solutions to clients' needs. He's currently signed to the Pineapple Group, which is Canada's fastest growing mortgage brokering firm. And Frank goes above and beyond to provide impeccable end-to-end service. The interesting thing is he boasts a 100% funding ratio in his portfolio. So what that means is everybody who he's helped or who has applied for a mortgage through Frank has gotten a mortgage. And that is a really big deal. So thank you very much for joining us, Frank. I also like to introduce Bisi Ogunwale, who is the president of Bisi Ogunwale Financial Solutions Incorporated, which is a firm dedicated to helping her clients meet clients with different financial solutions, and strategies to meet their needs financially. In addition to the many caps he wears, because he's a 360 degrees financial expert, as a mortgage specialist, Bisi works with the largest mortgage brokerage in Canada, which is the Dominion Lending Center. He has over 20 years experience in the financial services industry and over 500 hours training and speaking to a diverse audience across 4 continents. He's a social change agent, and he's passionate about empowering people with financial education and entrepreneurship. Bisi is a real estate investor, and he is also an angel, IT angel investor, as well as a venture capitalist. Okay, so having introduced our speakers, I'm going to go right into the conversation and say thank you very much for joining us, Frank and Bisi. You're welcome.
Thank you for having us.
Thank you. Okay, so Frank, I want to start with you right away. Can you just give us a sense of what is going on right now in the mortgage market? As an expert, you're in there, occasionally there's news about what's going on. Can you tell us, what is going on in the mortgage market?
Thanks, Namdi. So first off, to say thank you to you, Namdi, and of course the NCA GTA team. I think this is an incredible session where we can share knowledge with one another, exchange ideas, and of course, I'm proud and happy to share the platform with my brother and friend, Bisi. Again, for different reasons, one of which is that I find that we share the same passion, and we do this for the same reasons. And just to go into that before I go directly to your question, Namdi, is part of the reason, or the main reason why I do mortgage, or the main reason why I chose to be a mortgage agent, is because we need to enrich our lives. We need to inform people. We need to share what we know. I got a home a while back, and I find that information is not there. People show up and claim to do you a service or claim to do you a favor, when in actual fact, you could get those services for free. Bear in mind that a lot of us in this situation are coming from a different part of the world where mortgage is not exactly something we're familiar with. And then we're competing in an industry we know little to nothing about. And a lot of times we're in a hurry to get into the space, and therefore the first person that says, I can help you, we jump into their car, and then we realize that someone is trying to rip you off. So the essence of why we do this, and I know BCR shares a similar sentiment, is, guys, let us help each other to get better. Let us help each other to grow. Let us help each other to grow wealth in this country. And I dare say I've seen different forms of investment. Mortgage for me is still one of the strongest and best investment vehicles you can leverage in Canada. That said, to answer your question, the market is very interesting. Last year saw ridiculous change in the market. Interest rates crashed to their lowest low. Prime rates dropped. Lenders dropped their interest rates. Some banks went below 1% in interest rate. It's ridiculous. Just to give you an idea, the year before, in 2018, interest rates were as high as 3 points for variable rates. And then in 2020, these rates went so low. Part of what that meant was a lot of people started buying into the market. A lot of things happened. One is the major people that drove the sale and the growth of the market were not first-time home buyers. These were investors who already saw equity growing in their existing property. Therefore, they could draw equity from there and invest in more properties. Then the regulators decided to increase the stress test. Again, stress test is that amount at which you must qualify, or the interest rate at which you must qualify before you're extended a mortgage. Now, the idea why the regulators did that is, we know the interest rates will go back up. What they don't want is that the market begins to crash as the interest rate goes up. So they want to ensure that even though you're getting a ridiculously low interest rates right now, when the rates go up tomorrow, you can still afford it. You wouldn't fail in your payments. You wouldn't default. And what that meant by default, in some sense, is that the first-time home buyers, who mainly are either the younger population or new immigrants, didn't get as much of an opportunity to participate in the market. Again, tie that back to shortage in supply. We've seen the prices go crazy. Part of that was because there was a supply shortage. Raw materials were not coming from the US. People were hoarding houses, and there was a reason for you to hoard your house. So previously, what you would see is that people sell, buy another one, and move. Right now, you're seeing that people don't sell, they go buy another one, because the rental interest rates are still low enough for them to afford to buy another one and keep the existing one. So the supply of houses is very minimal. It's the lowest we've seen. At some point in 2020, it was pretty much the lowest we had seen in the long while. I think it was around August, where the estimation was that if within 30 days, nobody puts up a new house for sale in Canada, there'll be absolutely no house to sell. It was that bad because people were hoarding, people just didn't want to sell. Everybody was cashing in on the growth in equity of the house. The economy is beginning to pick up again. Interest rates are gradually climbing. We know the prime rates would go up at some point. So what's happening now is there's a scramble, and there's a scramble to get pre-approval. Because if you get pre-approval right now, that rate is locked down for the next 120 days. So people want to get pre-approval now that the rates are still slightly low. So the rates for prime, the best rate I've seen for prime is prime minus 1.3, which effectively is about 1.15 in interest rates. On the fixed side, it's probably about as low as 2.3, 2.4, goes as high as 2.89. Now, this is on the A side. On the alternate side, which some of you would call B side, it probably starts from about 2.79. So the rates are still reasonable. And so there's a scramble for people to get pre-approval. But pre-approval is one thing, being able to afford the house is a different thing. But again, one thing I'll probably say in closing, Nnamdi, is this. A lot of times people feel they can't get into this market. People feel the odds are against them. What I would always say to anyone is have the conversation, ask the questions. If you can't get into it now, can you plan to get into it in 2 months, in 1 year, in 6 months? What does that plan look like? But everyone should be able to create a plan. If you're not already in it, you should be able to create a plan. Either you can get into it right now, or you can get into it in some time in the future. But you never know until you start the process. You never know until you begin to ask the questions. There are different options that are out there for us, particularly those of us that are coming into this market. We are skilled employers or skilled workers. We have some assets at our disposal. We can leverage some of these things and tap into some products that some lenders are extending to us.
Thank you. Thank you very much, Frank. That was very detailed, and there's like so much to unpack there. You used a lot of terms, that I'm sure someone who is new to the market may not understand. You've spoken about pre-approval, you've spoken about variable rates, you've spoken about prime. And I'm hoping in the course of the session, we'll get into all of that. Bisi, I want to turn to you and ask, Nigerians are not particularly used to mortgages, if you're coming from Nigeria. I know these are some of the products that financial, industries the industry in Nigeria is trying to introduce and all of that, or, create a proper connect with Nigerians. So when people come here, they may not really understand, what this whole mortgage thing is about. I'd like you to tell us, so what is a mortgage about and where does it fit into the home buying process?
Thank you so much, Nnamdi. First, I want to say thank you to the Nigerian Canadian Association for putting this together. And I remain thankful for the opportunity that you guys have given me to share the stage with my very good friend here, Franklyn. Just before the session, two of us were bantering about, we didn't know that both of us are going to be here. We just recently, did a session together a couple of weeks back. But to answer the question that you asked, I need to put something into context for everybody to see. Can everybody see this screen?
Yes. Yes.
Can see the home ownership stats in Canada. This was what, CMHC, Canada Mortgage Home Corporation released. This was 2018 when these, stats were released. Mm-hmm. Look at where the Black community is in terms of home ownership. It comes back to that question that you asked earlier. Why is it that we don't do it? It's because we don't know about it. And then there are so many things that people read about, online, on Google. I've heard people say to me, I have to wait a certain number of years before I can buy a house. I have to wait a certain number of period before I can, buy a house. What is the mortgage process? I want to buy a house. I am looking for a property to buy. I can't afford to buy it with my own cash down. So you approach a financial institution and say, I want to buy this house. Going into partnership with you, you provide me with the fund. I put some equity into it, like my own skin in the game. Over time, I will be paying you guys back, the money that you lent to me for me to be able to buy this asset. When I finish paying, the asset 100% becomes mine, and then we can shake hands and say, thank you so much for helping me to do this, and everybody goes their way. Here's the thing. I haven't worked all my life in financial services. I mean, I remember when I was in Nigeria, there was a time we wanted to get into this space as the bank that I was working with then. It was tough. I sat on that desk and I can imagine what it was like. Why? We don't have the depth in terms of the depth of the capital market for us to be able to do this kind of things. We don't have the, the patient capital for us to wait for that long before investors will get their money back. Inflation is not in a place where you can have that rate of interest rate that is going to be favorable to people that were trying to buy houses. I recall that, when I was funding transactions back then, I was funding transactions with term loans, at ridiculously high rates. And before you know what's up, literally so many people would have passed away before they finished paying for that property. So coming out here, we come from an environment where everything that we do as a people is predominantly debit, debit, debit. You don't talk about credit in Nigeria, so people don't understand the credit economy that we run here. So when you talk to people about go and borrow money to do something, like, no, how can you be borrow money to do something? If you want to do something, you do it, buy it. That's how you know that you are the owner of the thing. You can't be borrowing money to do stuff. But you see, mortgage will remain one of the biggest, if not the biggest, investment that each and every one of us is going to ever take. So that remains a very big chunk of, investment decision that we have to take as a people. And that brings its own challenges. One, I don't know how it's done. I don't have an experience of it. I have read so many things. I've heard so many things. In our community, and I'm talking about the Nigerian community now, I just want to put it out there that people should seek information from the people who are knowledge experts in those spaces, as aside just, asking from different persons who don't truly honestly have the knowledge about it. How did I meet you, Nnamdi? You wanted something answered. You guys put the information out there. I connected with you. We shared information within ourselves, and we were able to find a lasting solution to that was the challenge. And that's how mortgage works. It's more or less about conversation. It's not about the complexity that we create about it. No single mortgage is the same. Every file has its own peculiarity and its own dynamics. It's until when you have the conversation around that particular deal that you begin to see the different layers of what can be done and what cannot be done. I don't believe there is anybody that cannot buy a house in this country. I just believe that there is different mechanism, dynamics, and then conversations to have with different situations. And that's just basically what it is for me about mortgage. Mortgage is not about the deal. It's about the conversations that we have around the deal and the way that you structure it. You have to customize everybody's deal according to their own situation to get it done. I've seen complex situations that we eventually funded. I have seen, seamlessly easy transactions that I don't have to even talk anything, just get in, get out. But I don't believe there's any transactions that can be done. There is something that can be done about everything. Thank you.
Thank you very much for sharing. Thank you very much for sharing that. Let's get into some nuts and bolts. We have questions coming in hard and fast. Obayemi would like to know, how soon can one access a mortgage when you just landed Canada as a new immigrant, if you have some down payment? Bisi, would you like to take this question?
Very, very simple. As long as you have a job that is, can be proven that I have an income, all you need is to have an employment that gives you regular income, and then you have passed the probatory period of your employment. Most times, probatory period is 3 months. So if you come in today and you have your cash and you have been working for the last 3 months, you can buy a house, after your probatory period of 3 months, 100%.
Okay, thank you. That's a very good question. That's a very good and clear response. So in 3 months after landing, you have a job and you've passed your probationary period at work, then you become eligible to apply for a mortgage. I'd like to ask you a question, Franklyn. Is it possible to apply for a mortgage directly, or do I need a broker? And if I do need a broker, why do I need a broker?
Yeah, so the short answer is yes, you can apply directly for a mortgage. You can, and what I mean by directly is you can approach a bank, but within the banks, there are people that are called BDMs who still handle the file. So there's always going to be someone between you and the underwriter and then the lender, of course. The benefit of the mortgage agent is that we have sight of different lenders. So we work with typically different lenders. I work with as many as 28 lenders, and these lenders cut across all sectors. So I can go to a bank, I can go to a monoline. So monolines are A lenders, but they are non-bank. I can go to prime alternate lenders who are like alternative. If you can't approach a bank, the next step. And if that doesn't work, and I can approach a private lender. Now, the difference in all these things, back to what Bisi said, is the quality of your file. Sometimes the difference between why you cannot go to a bank, an A lender versus an alternate, is your credits, for instance, or your employment history, for instance, or your income. And as you go down, there might be some tweaks in terms of interest rates, but the ultimate thing is that you're able to get a house. Back to Bisi's point as well is you can get a mortgage within 3 months of landing into this country. A lot of people probably do not know that, but the conversation shouldn't start after 3 months. You can start the conversation 3 months earlier so that you begin to plan the book, because the market is always moving. So the earlier you start the conversation, the earlier you're able to get into that space.
Okay, so I have a question that's related to the last comment you just made. This is from Oladapo, and he's asking, how easy is it for immigrants who are still in employment back in Nigeria, but working remotely? So in other words, what they have is foreign income. How easy is it for them to access a mortgage? So Franklyn, please.
Yeah, so it's very doable. It depends on the peculiarity of the situation. So what banks typically would take is, if you're coming from overseas, there is a package for overseas investors. The question sometimes becomes, are you going to be resident in the property here, or are you buying it as a rental property? And those two files are treated quite differently. So depending on how long you've been in the country, what your work history is from back home, some lenders will consider your work history, provided that you can prove that you've been there for a period of time. You can prove your payment. Of course, if you work with a global company, for instance, it even makes it a lot easier. You go through the process of verification as well. Some of those things, sometimes, if you have to then go to an alternate lender, it might have an impact on rate. There might be some fees to pay. But yes, it's absolutely doable, but it all depends ultimately on the peculiarity of the file, but it's absolutely doable.
Thank you, Frank. I do want to ask you a question before I pivot to Bisi. Now, a lot of people seem to get mixed up about what the role of a mortgage agent is versus the real estate agent in the house purchase process. So can you share with us what the difference is, and if there is any relationship between these two people, how that works?
Thanks, Namdi. And that's a really great question. And you're right, it's a great misconception in the marketplace, or misinformation, and people probably don't get it. So this is the way it works. The mortgage agent is the go-between between you, the buyer, and the lender. So I'm the one, and Bisi is the one that facilitates the conversation to ensure that the lender gets you the money to buy the house. The realtor is the go-between between you, the buyer, and the seller. Yeah. So the realtor's role is to ensure that they find you a house that meets your needs and that you're able to buy the house. They have no business, or they should have no business, with the money. Actually, mortgage agents and realtors should work hand in hand to satisfy client needs. But sometimes in the industry, you find some of these roles overlapping. It's not supposed to be, but sometimes it does happen, because again, information is out there and people share information, even though it's not necessarily their area of expertise. But realtors primarily are supposed to land you the house that you want. Mortgage agents are supposed to get you the money to fund the house.
Okay, I like that distinction. The realtor helps you find the house. The mortgage agent helps you find the money to buy the house.
Yeah.
Thank you. Thank you very much. So Bisi, I want to come to you. I mean, earlier during the introductions, I believe one or the both of you mentioned how mortgages serve as a form of investment. And there's a question here from Jonathan. He wants to better understand how refinancing a home to what the implications are of refinancing a home to buy an investment property? Are there positive or negative implications?
Well, that's a fantastic question. And that is one thing that I see many of us not taking advantage of. So what does refinance mean? Simple. You're literally just basically either buying back the house that you already, fully paid for, selling it to yourself and then collecting the money again, or you're looking at, okay, how much equity is in this particular property and how much of what is in there can I take out? Now, there are two ways to look at it. If you have refinancing to do, it can also, be misconstrued as doing home equity line of credit. And I try to explain both of them, right? So for example, I buy a house for $500,000, hypothetical number. And the market is now at, say, $800,000. Although my mortgage term was for 5 years and I'm just like the third year into the mortgage. And I'm looking at, oh, that's extra $300,000 in there. What can I do? You don't want to sell the property, but you want to be able to take money out of that. So you approach a financial institution, whether a bank or any of the other guys who are lending for mortgage, purposes, and say, oh, XYZ Incorporated or ABC Incorporated, I have this mortgage. The property is worth this amount. They will do an appraisal themselves. And it's on the basis of the appraisal value that they do that they can begin to talk to you about what your refinancing options are. So let's assume that so far since you bought the the property and you finance it with a mortgage, you've been paying down your monthly or bi-weekly or whatnot frequency that you're using to pay down your mortgage. Let's say you have $350,000 left on that mortgage. Between the $800,000 valuation and $350,000 mortgage that is left, there is that bracket of equity that you have built into that investment. In this case, the property. The bank will look at what is the 80% of that particular property at that point in time. So we say $800,000. 80% of $800,000 will be $640,000, right? And then they will look at the difference between the $350,000 that your mortgage is remaining and $640,000 that the 80% is. You can have access to that amount of money as equity that you can take out to go and do whatever you want to do with it. That's refinancing or taking home equity line of credit. And then you can go and use that to fund other transactions. Now, what you must remember is if you want to refinance, what that means is that you are taking your mortgage away from one place to the other. You are breaking what you currently have. That will mean that you have penalties that you have to pay. If it's a closed mortgage that is fixed, it could be rate differential or 3 months rate or interest over the period. Whichever one is higher is what they're going to take from you. If you're doing home equity line of credit, I don't want to break, I don't want to do anything. Just make sure that I can have access to this amount of money. In this instance, $350,000 to $640,000. That's $290,000 if I'm not mistaken, right? So that $290,000 is made available to you like another line of credit. But in this instance, the line of credit is being backed by the property. So there's a collateral for it. It's not an open credit like a normal line of credit. The property itself is the collateral for that particular stuff. So you find that HELOC, home equity line of credit, has lower interest rate compared to your typical line of credit. And then you can then take money out of that $290,000, in this case that we're using as a hypothetical number, to go and fund other transactions that you want to fund. Mind you, there would be legal documentation noting that what you are owing on that property has now increased to that amount. As you use it, the amount you are owing goes up. As you pay it down, if you ever do, the amount that you are owing goes down. As you pay down your mortgage, you have extra room for that particular amount of dollar that you can use to do whatever you want to do. When you want to do another transaction, the amount of usage that you have taken out of that line of credit is what is going to be showing on your liabilities when you are writing mortgage for another, another property. So those are the ways people use one property, take money out of it, fund another property, take money out of it, fund another property, and then you see people having multiple properties over time.
Thank you very much. I know that was quite detailed, and for somebody who is new to the market, they might have been struggling with some of the terms you've used. But that question was really more for people who are already in the market, who own a property and are looking to expand their portfolio. So if you are new to the market, don't be scared about some of the terms you might have heard Bisi using. I do want to, come down to some more fundamental questions. And so staying with you, Bisi, D is asking, is there any particular amount one needs to earn to start talking about mortgage for a home?
That's a very smart question. And thank you for asking that question. To be honest, it depends on the market. It depends on the amount of property that you want to buy. And also depends on where do you want to live or where you want to buy the property that you're buying. It is tough to answer this question because in Ontario today, everywhere is hot, red hot. So it is so difficult to find properties that are, I'm not saying there are not, but you have to move out of the regular places that people already are. So for example, I funded a transaction a couple of days back, and this person just says, I want to buy a house. And I looked at the person's income, combined income in the family is just about, say, $100,000 or thereabout. And they still need to buy a property. So we did a pre-approval for them, we pre-approved them, and then they only have, say, around $400,000 or $420,000 of pre-approval. They found a property in Windsor for $397,000. Or somebody who says, I want to buy a property, this is where we have $120-something thousand combined income and all of that. They bought a property in Fort Erie, right? But for you to stay in the GT area, Hamilton, London, Waterloo, and all those places, things are just basically as in piping hot going that way. So there is no specific amount that you should have. And you see, this is one thing that I should also say to people. When I look at other provinces, I'm seeing properties in those places that are quite, $195,000 for a 3-bedroom, semi-detached, with backyard that is big and all of that. Go to Moncton, Fredericton, go to places like Moose Jaw in Saskatchewan. You find all manner of transactions that you could do. So there is no one size fits all in terms of numbers. What is most important for you to know is, if you want to have like a rule of thumb, is to look at what is the combined income in the family. The rule of thumb is you can find mortgage between 4 times and 5 times that. And that can give you a perspective of where or how much you can buy.
I like that suggestion. So if I understand you correctly, once you're able to establish what the total income in the family is, you could now say multiply that by 4 to 5 times to get a ballpark figure of how much you could potentially get. Is that correct?
Absolutely.
Okay. But I do like that you mentioned.
However, sorry, let me just quickly add one thing to that. However, also know that, so Bisi said 4 to 5, and then you stay at 5 just because, that's where you want to stay. You also need to realize that when we pull your credit, we will see liabilities that you already have on your credit bureau. Those would also go into the calculation of the ratios that we calculate. So there are 2 major ratios here, TDS and GDS, total debt service ratio and gross debt service ratio. Those 2 ratios go hand in hand to know exactly what you qualify for or what you don't qualify for. You must stay below 39.4% and then below 44% for those 2 ratios to work. Otherwise, it might be tough. In some instances, if you are doing more than 20% or 20% and above down payments, there might be conversations around, okay, what can we do? And then maybe some approval and exceptions can be granted in some instances.
Thank you very much. And again, this is how it goes, right? the more you talk about it, the deeper you get into it, the more acronyms are popping up and maybe the more complexity. But what I find very exciting about it is once you are speaking to a mortgage agent like you guys who knows it, then, you know, someone can get confidence around what, you know, the whole market is about and, you know, chart a clear path towards this home ownership objectives. But I see a response from D who asked the question. So I think you've actually answered to D's satisfaction. Franklyn, I'm going to come back to you and ask. We've spoken here consistently about having some form of down payment. So obviously, you need to have some, to use Bisi's words, skin in the game to be able to access a mortgage. But what are the other things one needs to qualify for a mortgage? Is it just to have money and employment and to be here for 3 months? Can you give, like, you know, what are the things people need to know and have to apply for?
Great question, Namdi. Let me start from where Bisi ended, talking about the TDS and GDS ratio, because that's very important. So the way it works, and simplifying it in what I think probably be the simplest of terms, is your TDS ratio is, so if you put it at 39%, which is like the norm, where you shouldn't exceed, it simply means that the government is saying to us that for every investment or home ownership investment we have, it shouldn't go beyond 39% of your gross income. So what falls into that TDS are things like property tax, heating on the house, your repayment, of course, which is both your principal and your interest rate. And of course, if it's a condo, your condo fee. That's the TDS ratio. Put that at 39%. Now they add an extra 5% to take that up to 44 and say, we would also look at the fact that, do you have car loans? Do you have credit card loans? Do you have any other debts you're carrying? So overall, your entire portfolio of debt, so to say, shouldn't exceed 44% of your gross income. Now, different lenders, to Bisi's point, will look at it a bit differently based on your file, based on what you're bringing to the table, and they can extend to you. So that, on the one hand, is one of the things they consider. Of course, income is a very important part. Income is very critical to the conversation. The other thing that is considered is down payments, and down payments are, of course, very critical. So within the industry, there are high ratios, which pretty much means that you are bringing less than 80% of the value of the house. So if you're bringing less than 20% of down payment. And of course, if you're bringing 5%, it's on a different side, and that's an insured mortgage. If you're bringing above 20%, that's insurable. Again, means that you can decide not to have CMHC on your file because you're bringing more than 20% down payment. The other thing that we rarely talk about that is actually considered in most mortgages is character. So one of the things we don't know is that most lenders actually go to look you up when we submit your files as lenders. So if they look you up, for instance, and they say this guy has a rap sheet or is probably a drug dealer and there's so much news about him, even though your file looks good, they can come back to you and say, we're sorry, we can't fund this deal because we don't believe this guy is credible. Because the last house we see he owned, he was using it for a meth lab or things like that. And I'm saying this because it has actually happened. But character is one of those things that they check. The final thing I'll mention that is also very important, this is a very broad overview, because in terms of documentation, there's a lot of documentation we have to submit. The final thing I'll mention is credit. So your credit score counts a lot. Your credit score is important. So the difference between whether you can approach a bank, an A lender or an alt lender, is the credit range within which you fall. And so if your credit score is not so good, and by credit score, I mean when we pull your credit score from the bureau, we'll see all sorts in there. We'll see whether you've ever declared for bankruptcy. We'll see whether you failed in your payments. Are you carrying some instrumental loans or some revolving lines of credit? Again, those things are not bad, but they need to be serviced. If you take a loan, be sure to service it because it shows. I would also mention here, and this is kind of extending the question, Namdi, is a lot of times there's this misconception around, I've gone to a bank to apply for mortgage, they pulled my credit, I'm coming to you as the lender, please don't pull my credit because it's going to affect my score. It's false. What Equifax and TransUnion do is, if you pull your credit within a 45-day window for the same reason, so you go to Lexus, you go to Benz, you go to Toyota within a 45-day period, and they pull your credit, it counts as one. It doesn't count each time you go to pull it. The same thing applies for mortgage. If you pull within a 45 period for mortgage reason, it counts as just one pull. So you can pull as many times as you want within that 45-day window, and it doesn't impact what goes into your mortgage or your credit score. Your credit score stays same. It's impacted just once. So primarily, those are the factors that would affect that we consider for mortgages.
Okay, sir. Please, I just have one question. When you say loans, what type of loans do you think will affect one's credit? You know, you said loans. We have different type of loans. We have the credit card. We have student loans. Different type of loans. Just explain to us. Will the credit card loans also affect your credit?
Yes, so it does. So to different extent, it depends on the kind of loan. They all affect you to different extents. So this is a golden rule in terms of building a credit. It's called a 2x2x2, which simply means the advice if you want to build a credible credit is have 2 credit cards that have a minimum balance of 2,000 and hold it for 2 years. So that way you're showing to the bureau that you have a stable financial sense. Of course, the ask as well is that we always spend at least 30 or not more than 30% of your credit limit. Yeah, meaning that if you have a credit limit of 2,000, do not let the balance go beyond 600 at any given time. Because once it goes above 600, it begins to impact you. This is also one misconception I've heard. If the bank calls you to say, hey, Mr. A, you've been approved for an increase in your limit from 10,000 to 15,000. Don't go, oh, no, I don't want it. Please don't put me in Bisi. No. Please take it. Because what that does for you is as long as you're disciplined enough to not expand your needs based on that, you would find it difficult to hit the 30% mark, because if you're spending 5,000 on 10,000, that's 50%. If you take 5,000 or 15,000, that's 33%. So automatically your ratio or the amount of money you're spending on that line becomes a lot lower. But overall, any credit or any payments you default on and is reported to Equifax or TransUnion would impact your credit score.
Okay, what is Equifax? What is that?
So Equifax is the credit bureau. So they're primarily two. There's Equifax and TransUnion. These are guys that, and just to make this clear, Equifax does not know anything about us or about you and I that is not reported to them by the owner of the credit. So what's done is, if you bank with TD, for instance, TD will report every month to Equifax that, hey, this person has this limit of credit, this is the amount they used, and they are not owing us, or hey, they are owing us. If you have a debt you're supposed to pay that you've not paid, it will report it to Equifax to say, this person took a line of credit, he was supposed to pay 500 this month, he has defaulted on it. Now that's revolving, and to show that you've not paid. If you have an issue and you even go to court, and court passes judgment on your case, it will also be reported to Equifax, so that any lender at any time in the world or at any point in time that wants to understand how stable is this person from a credit perspective, can I give them money? Because understand, from a lender's perspective, they're taking a huge risk. The lender is not a realtor. They're not looking to sell houses. When they give you 600,000 or 500,000, they want to be sure that you are disciplined and able, and you've shown over time that you have good financial sense and you can manage that money. So they want to pull that credit report to see how you've behaved with money that's been given to you in the past.
All right, thank you, Franklyn. Thanks, Franklyn. Bisi, I'm going to come to you with a question now. Peace is asking, if a home costs 850,000, how much down payment do I need to have before I start talking to a mortgage agent? Also, before you answer, let me combine it with a question which has come from Yinka as well. Yinka is asking, what other costs should I consider beyond down payment when planning for a mortgage?
Okay, thank you so much, Namdi. Before I answer the question, it was just as if you read my mind as to what question, because I was going through the questions that people put in the chat that, it'd be nice to talk to people about. There is one more question that spoke about home insurance or something like that I would like to talk about. But let's talk about this first. So in terms of down payment, there is a simple rule to how much of down payment do you need to buy property. So the first thing you need to know, exactly how much is the property price. So in this instance, it's $850,000 that the question, the person that has the question has asked. The first $500,000, you are allowed to put 5% down payment. So 5% of $500,000 is $25,000. Anything above $500,000, you have to apply 10% to it. So 850 minus 500 gives us $350,000. So you apply 10% to that. That's $35,000. 25 plus 35 means you have to have down payment of at least $60,000. Now, to go and answer the next question, we've talked about down payment. There is something that we call closing cost. So in some instances, there will be PST that you have to pay on land transfer fees, PST that you have to pay on, mortgage default insurance. There is land transfer fees, there is lawyers and all those kind of stuff. In some cases, there might be appraisal, you have to pay that, inspection, all of those kind of stuff. Those are cash that you still need to be able to, to put things. But the rule of thumb is to say that closing costs will be about 1.5% of what the property price is. So let's go back to the $850,000 property again. You've put aside $60,000 at down payment. So 1.5% of $850,000 is what you should be thinking about as the closing cost. And that should be about 1% of 8,500 is 850,000, 8,500 plus. So that should be about $12,750. So add $12,750 to $60,000. So for somebody who wants to buy a property of $850,000, you should have nothing less than at least $75,000 that will be comfortable enough for you to have down payment and closing costs together. Now, to go to the other question that I was speaking about earlier, I think it's important that we talked about that. And the reason is just because I've seen a lot of, misconception around how it works. So when you are doing mortgage, there are several types of insurance that are involved. So let's start with somebody says mortgage insurance. People have confused mortgage default insurance with mortgage protection insurance. Those are two different things entirely. So let's start with mortgage default insurance. Normally, when you want to buy a house, the thing we expect is that you should have 20% down payment, that your loan to value for that property should not be more than 80%. But we have high ratio. When we say high ratio loan, those are loans where people have less than 20% contribution as their own skin in the game. So you have to have a default insurer. In this instance, CMHC, Sagen, and Glenworth. Is that what they are called now? Or Canada Guarantee? I can't remember. They changed their name recently. There are only 3 of them in Canada. They need to give an assurance to the financial institution that is trying to lend you money to say, we've assessed the risk of this particular person. And we believe that, okay, we will be able to fund if it were to default. So we're going to give you an insurance to say that if this person defaults, you can come back to us and collect the part of that extra that is not getting to the 20% that he or she is supposed to do. So for you to have that insurance from a mortgage default insurer, you have to pay premium for it. And that premium is added to your mortgage and you pay it over a period of that amortization period for you to pay the mortgage default insurer. And let me say this here. If you have to insure a mortgage and the mortgage default insurer says no, there is no lender that is going to lend you money. Because the ultimate risk that the lender is carrying is that this person does not have enough down payment to get to that 20%. If any of those default insurers says, we're not going to be able to treat this well, none of those financial institutions will take a bite. So that's that with mortgage default insurance. Then there's mortgage protection insurance. Now, as financial persons that is helping you to get mortgage agent, mortgage brokers, it is our ethic responsibility to let you know that you have to insure yourself so that the financial institution that gives you money or give you money or intending to give you money for you to buy a property have comfort that if anything were to happen to you, like premature death, like critical illness, like disability, they have coverage to know that their money is not going to be hanging in the balance. That is what mortgage protection insurance is. However, I need to make a very serious clarification here. The mortgage protection insurance is the bank's own. It is not yours. Even though you are the one that is responsible for paying the premiums on a monthly or regular basis, if there is a claim, the bank will get paid directly, not your beneficiaries. And once the bank is paid, your family or whoever you have that is, in your estate can then own the property as long as whatever is paid is enough to pay down the mortgage. Now, there are several complications to this. Mortgage protection insurance is post-underwriting insurance. Post-claim underwriting. Because somebody asked a question, do I have my own individual or do I take the bank? It is not compulsory for you to take the bank. It is compulsory for me to advise you about it. But you have the right to say, I don't want that. I want to do my own personal stuff. Now, the difference between the two is that for your personal one, you can decide how much exactly do you want or how do you want to appropriate distribution to whoever you want to distribute it to. That's your own prerogative. The bank just look at, I borrowed you $500,000. I lent you $500,000. I need insurance for $500,000 to cover if there is any eventualities, premature death, disability, critical illness, so that they are covered. But you can do your own insurance in any way that you want it. I have a small video where I explain these mortgage protection and individual insurance. If anybody needs that resource, I can send it to them. Now, there are other insurance that are still involved in buying properties. You need to physically insure the structure. That is called property insurance. No lender will give you money to go and buy a house without knowing that if fire were to happen or there were to be flood or anything, that physical property has to be protected. That's the third insurance that we talk about. And then there's also title insurance. Title insurance, your lawyer deals with that. What does title insurance mean? Back in Nigeria, there's something that is called omonile. So they sold one's land to different people. People are fighting about who has the original title or something like that. Here, in the past, it's happened too before because people were fighting about land because registration of title were done wrongly or there were errors or even, forgery and stuff like that. So you need title insurance. Your lawyer helps you to do that so that they can protect your interest in that particular property and that of the bank together. Those are the different types of insurance and how each of them works. If anybody needs further information around that, we can take that outside of here.
Thank you very much, Bisi. I know that response is very comprehensive. So for people who are just joining us, we have Frank Ben-Awurum and Bisi Ogunwale, who are mortgage experts. They are here teaching us everything we need to know about achieving our home ownership goals in Canada, regardless of whether you are a new immigrant or you are an existing property owner who wants to consider different investment options. Right now, we are 5 minutes away from 12 noon, which was our original plan to stop. But I can see the questions coming in hard and fast, and the room is even growing bigger. So we're going to ask permission to extend by max another 15 minutes so that we can take as many more questions as possible. However, just to give you some comfort, even if your questions don't get answered or resolved completely, we're going to be sharing contact details for the two gentlemen so that you can connect with them afterwards. In addition to that, this video or this session is being recorded, and a video of that recording is going to be made available on our different platforms, from our website to social media. So, staying with you, Bisi, I'd like you to just explain the concept of a mortgage cashback.
Okay. I mean, it's very simple. Cash back to you. I mean, it's just as simple as that. But let me just quickly break it down. You know, when you want to buy a house or you want to invest in mortgage, you put all your money into putting down payment down. There might be instances when people want to do maybe repairs, renos, people wants to buy new appliances and all this kind of stuff. And the money that is left is not, it's not enough. So there are some lenders that are doing, cash back. And what does that? It's not as if they are giving you free money. Please, let's take that, quite clear here. They just advance you some money so that at least you have ease of, I want to do something and I can quickly take care of it. Normally, what I've seen in my experience is you get maybe 1% of whatever the mortgage amount that is extended to you in cashback is. In some instances, we've seen lenders doing between 1 and 7% most times, but a lot of the time it's just 1%. So how do we calculate this? What happens is, let's say, for example, you want a property of, let's do $850,000 that we'll be talking about here. Now, if we say 20% down payment, that is 100 and, how much is that? 85 plus 85, that's $170,000, right? If you take $170,000 away from 850, sorry, let me quickly use calculator. My brain is not as sharp this morning. That leaves you with $680,000, right? What the bank will do is to say, if it's the bank that is saying we do cashback of 1%, they'll give you 1% of $680,000, which is $6,800 as, the cashback. That $6,800 is going to be added to your mortgage. It's not as if they give you free money. Let's say that what they are doing is just they are extending cash to you so that you can manage other things you want to manage. And that's just pretty how cashback works. Nothing is free. It's wiped into the original loan back, but they are giving you the cash to just say, okay, if you want to do anything, you need extra cash, you can use this. I don't know if that answers the question.
Thank you. So essentially, they're not trying to encourage you to buy the house by giving you some kind of incentive.
It's not incentive, please. Don't let us get it wrong.
Okay.
It's just we know you might need cash, so we give you this.
Okay, thank you very much for clarifying and correcting the notion I had. So Franklyn, I'm going to come to you, and I would also invite Olori Adedipe to unmute themselves and ask their question. Olori Adedipe, are you there?
Yes, I'm here. Thank you very much for this opportunity, and thank you for everybody, the host and the presenters. So my question is this regarding credit rating. So I'm a prospective first-time home buyer. And I'm now in the market, to just make sure that I have all my ducks in a row and get, go, invest in mortgage. So just 2 months ago, my one of my banker, my credit card expired. So I wanted a new credit card, and I called him, to have it replaced. But instead of the banker doing that, she canceled my credit card entirely. She canceled the account. So I just want to know, because I've listened now, you need to have 2 credit cards that you can use to, to get your credit rating going. Does this affect my credit rating or my chances of getting, a mortgage? Thank you. Yeah. So that is the first question. The second question is, both my husband and I, we work, our work is based overseas, and we want to get a mortgage. I work from here in Canada virtually, but he works from South Africa. That's where our offices are. How do we navigate, buying, getting mortgage, doing our mortgage investment? Thank you.
Well, Franklyn, you got the 2 questions, right?
Yeah, I did.
Awesome. Please go.
I did. So let me start with the first one. Again, just a basic education on credit. So the way the Equifax system works, for instance, is you have a rating from 300, which is extremely poor, to 900, which is fantastic. There are different scores within that. You have excellent, you have good, you have poor. Now, a lot of credits, a lot of lenders would have conversation with you as long as you hit certain marks, say 680 and above. If you're excellent, you're above 720, good. They'll have that conversation with you. Now, credit cancellation is dependent on why the credit card was canceled. If it was due to no fault of yours and that was reported to the bank as such, you didn't default on any payment, there was nothing, no fraud that was reported on the account, it was canceled due to an error, human error, and it's captured at that, what you would suffer is the lack of the history you've built over time. So think about it, you have a credit, which is why, and by the way, probably a good time to also say, if you have a credit card you've used over time and you no longer want to use it, please don't cancel it, just keep it, because there's history there. And the history, which is the longevity of the time that you've used that card, counts to give you a solid credit score. So please don't cancel your credit card. However, if it's been canceled, you wouldn't have a penalty on your credit score if it's due to no reason of yours. I'll give you an example. I had a Hudson Bay card, and Hudson Bay, for whatever reason, changed their bank from, I think, Duo to someone else. And they told me that my card would be canceled. If I wanted a new card, I could come back and reapply. I never went to reapply, but my card was canceled. On my report, it shows as canceled, but it had no impact on my credit score. Yeah, because it wasn't due to any fault of mine. They switched bank and therefore they had to cancel the old card to get a new card. But if anything is reported, so what I would ask is that you please follow up to be sure that on your Equifax report, they are not reporting a claim against you, because that could go really bad if that's the case. So everyone is aligned on the reason why it's canceled and it's an error versus a default from your end. Yeah.
Yes. The banker said it was an error. In fact, I still have a credit. You know, I've owned this card since 2011, and the limit is 6,500, and I had my own money on the card itself, about $500. So she said she made an error, you know, on it. So, but it has been reinstated back. Because it was reported within 60 days. So I'm just worried about the history and how it affects my credit score.
No, so and just to answer that, it wouldn't have an impact on your credit score. But just to also advise is, there are free platforms where we can monitor our credit score. So there are things like Borrowwell, for instance. I know there's this second one. The name is not coming to mind right now.
Credit Karma.
Sorry?
Credit Karma.
Credit Karma, yes. So there's Borrowwell, there's Credit Karma. You can have each of these things. And I know Borrowwell, for instance, every 7 days, it kind of updates you on changes in your report. So have you stayed flat? Have you gone down? Have you gone up? And you can kind of see the reason to why your credit card is moving. So I advise everyone, please sign up to these platforms. They're free, they cost you nothing. They don't give you the detailed report that we would get if we pulled your credit report, but at least it gives you your score and it shows you your different lines of credits and how they're performing. So yes, I advise that you use those platforms.
Thank you.
Sure. To your second question, so you and your husband are working overseas, you're working remotely from here, your husband is out of country.
Yes.
Now, overseas package can be handled. And they are, I would say they're increasingly happening. Excuse me, they're increasingly happening. They are not as conventional as if you had a full income here, you had your credit reports from here, because for some of the overseas deals we're seeing, they're even coming from countries where you can't even get a credit report. So imagine overseas from Nigeria, and there's no credit report to pull from there. Now, this would then impact where we take the file to. So can we go to a prime lender? Maybe not. Can we go to alt lenders? Possibly. Can we go to private investors? It's a possibility. The question becomes, what is your status in Canada?
Yeah, to answer your question, I'm a citizen.
Okay, great.
Both my husband and I are citizens. Yeah.
Okay, so that income will be used. What would then happen is, as you look at the file, they'll probably require some document. I think I talked to this earlier. You'll probably need some 2 years history on your work history. The income will be compared or be checked to see how they can leverage it to fund the deal here in Canada. But is it doable? It's absolutely doable. The other conversation then becomes, is it going to be treated as a rental property, or are you going to be treated as a first-time home buyer? Because bear in mind that one of the things we forget is first-time home buyers means you don't own any property anywhere in the world. Yeah. So if you're not a first-time home buyer, it becomes a different conversation. If it's not your primary residence, it becomes a different conversation as well. But yes, those kind of files can be handled, which is going back to Bisi's point. I think Bisi made this point earlier. Conversations are very key. No two files are the same, but once we see every single element on that file, credit reports, for instance, how much down payment you have, what sector are you working in, How stable has that income been for a period of time? What kind of house are you looking to get? Those kind of files or those things will be considered in its entirety before it is submitted and approved.
Thank you.
Does that answer you?
Yes, it does. Thank you.
Awesome.
If I might just ask something quickly to what Franklyn just said. You might also find that lenders will consider, if depending on the currency you earn, you might consider to say, okay, for foreign income, you have a certain amount of down payment that you would have to put down. So, I mean, I've found transactions where people are earning in Naira, but they are living here, but they would require to put 35% down payment before you can go on with those transactions. So that might be part of the conversations at any point in time, depending on where the current, I mean, so I hear you say South Africa or something like that. That might come up, yes, so that at least you have that at the back of your mind when that conversation comes.
Okay. One more question, if you don't mind. How does having an RRSP help my mortgage application?
As a first-time home buyer?
Yes.
Right. So if you build RRSP up to a certain point, because it's tough to find money to, to put down for payment as equity in property. So the government allows first-time home buyers to take money out of their RRSP towards putting down for their first time buying of house. It is not as if you can use RRSP for other ones, but there are different ways to treat that. But let's just stay where first time home buying is. Subject to a maximum of $32,500 per person, you can withdraw from your RRSP and use it as part of your, your down payment. So let's say, for example, you and your husband are both citizens. If you have RRSP that you built up over time to say, $50,000 a piece, if you wanted to buy a house, each of you could take, subject to a maximum of $32,500 out of your RRSP that you built over time and use it as your down payment. Now, here's the thing. You have to return that money starting from the third year post the buying of that particular property. It doesn't matter how, but you have to put everything back in the RRSP, because the reason why you set up RRSP in the first instance is because it was his retirement savings. I hope that answers the question you were asking.
Okay, so Bisi, I want to quickly ask you a question about employment. Someone is asking, if they are on a contract job but have the 20% down payment, can they still access a mortgage?
Sorry, if they are what? Say that again. I lost you for a bit.
Okay, if they're on a contract job but have 20% down payments to make, can they still access a mortgage? And as a rider to that, still on employment, Latoya is also asking, if one spouse is working and earns good pay and the other spouse is schooling, can the working spouse apply for the mortgage alone, or do you suggest they apply together? So these are two questions around employment.
Great questions. Fantastic questions. See, the first question is around whether you're on a contract. Definition of contract, is vague here, but I will try as much as possible to address some of those contracts. So, are you a contractor that incorporated a business and you are using the business to get jobs and then you execute? That's a contract. Or you are an employee of an organization, but you have a contract that is for a specific term. Those are two different things. But I'll use the second scenario as what I've seen mostly. So you have a year contract, 2 years contract. Most lenders want to see that at least this person has a contract of a minimum of 12 months as at the time when they are giving you the mortgage. Why? Because if you have a contract that is going to expire next month or 2 months after, it becomes a challenge. Where is my payment from this mortgage going to come from if your mortgage, if your contract for the employment is going to expire? Regardless of whether you have 20% or you don't have 20%, that conversations have to happen. It's easier for somebody who has 20% with a shorter contract compared to somebody who doesn't have 20% and then that person has shorter contract. And I use myself as an example. When we wanted to buy our first property, I was working, my wife wasn't. She was schooling, but she had a contract job as a student with a bank at the time. I don't want to mention the name of the bank. We wanted to buy because we already have money to put down as down payment. So because she was working as a contract staff in that bank, we approached this bank and said, we want to be able to buy a property. We believe that we can afford it. And they said, no, we can't, because your spouse is having a contract and the contract is just for 6 months. And this is why I got into this business of mortgage in the first instance. So one of the staff told me and said, talk to so-so person. He used to work with us here, but he's now in mortgage business. So I rang this guy up and said, see, this person says, once I mention her name, he said, oh, that's my very good friend. What can I do for you? I explained my situation to the guy, and he said, okay, don't worry, we'll find a way around it. Let me go and talk to them. He went back to the same bank, and they were like, we will do the transaction if the contract can be extended maybe another 3 months. So it's now 9 months on that particular contract. As God will have it, 3 or 4 weeks down the line, we got an extension that will take us to another maybe 16 months down the line for our contract to expire. And then these guys, they gave me, a pre-approval. I was just like, I thought this bank said they were not going to do this deal. How is it that, you went there and then they said they are going to do the deal? And the guy says to me that they know that if they don't do my deals, I could take it somewhere else. And they want to do deals with us because, so I sat down with this guy, I tried to understand. So talk to me about this mortgage process. And he says, I have this number of companies, that financial institution that we deal with. Every one of them wants to get our business. So they will be looking at, okay, you have reviewed this file. And so if you have reviewed it, then we think we can do this with this exception there and there, and then we can. And immediately I just went and collected, I registered, I said, I want to be a mortgage agent. Because I found that there were so many people who were in our situation who couldn't find what they were looking for, and then they just gave up on the search because one financial institution says, we can't do it, when they could have gotten into the place and begin to build equity. All right? So to answer your question, yes, it can be done. We just need to know exactly what can, Nnamdi, you and I had this conversation about a couple of months ago, and then it was like, oh, I didn't know that this was possible. We didn't know that this was possible. There's a lot of things that is possible, but we first and foremost need to talk about it. Don't take no for an answer until you have explored all options that are available. I'll give you another very good example. I just got to fund a transaction this past week. When we got into that transaction, husband and wife, they had jobs. A couple of weeks before we are going to close, the wife lost the job. And then we have to fund that transaction. Otherwise, they will lose their deposit. There are other ways where you can go and say, okay, this guy is a rental property, we are putting 20% down. What are the concessions? Even if it means that we have to pay a little extra so that we don't lose what we already have invested in that property. There's so many things that can be done. Now, to second question, where husband is working or the spouse or the wife is working and earning good income, the husband or the wife is in school, and then please put the two of you together in that application. Don't remove anybody for tax purposes now, because when you have joint tenancy, in this instance, man and wife or spouse plus spouse come together to buy a property. If one of them were to predecease the second person, there is joint tenancy in that property. The second person continues to, stay as the owner. It is until the passing of the second person before capital gain taxes becomes, imminent. But if in this instance, you don't put the second person because the person doesn't have income, just put it that the person is an homemaker. That's a job on its own. It's a job function, homemaker. I don't do anything, homemaker. And put maybe a small amount of money for that person. I find that kind of person, you can use the CCB that you collect for the children, if you have, as the income for that particular person, and then you can just, it doesn't matter whether somebody has income or not. As long as the income that is in that family can fund the transaction, you'll be okay. I hope that answers the question. One last question that I saw that I want to address before we leave here, it has to do with capital gain taxes. Somebody asked the question around, if I wanted to move away from one house and go and buy another one, explain what the process flow is. It's very simple. If you are selling your house, the money you get from that house, you go and use it to buy another house. Now, if it's a house that you were living inside as your primary residence, it doesn't qualify for taxes. All of the gains, just like you're asking that question, I can't remember who asked the question. All of the gains that you made on that is 100% yours to keep. But if it was a rental property, you have to pay capital gain taxes if you sell a rental property. And the way we treat, CRA treats capital gain taxes is 50% of the gain is subject to taxes on the marginal tax rate of the person who is the investor. So let's use an example. You bought a house at $500,000. It's now at $800,000. If you are the owner of the house and you live in that residence, the entire of that $300,000, if you sell it today, is yours to keep, not paying a dime to anybody. Or if you had it as a rental property and you now sell it, $300,000 is the gain. Divide $300,000 into two. $150,000 is what the government is going to tax based on your marginal tax rate. Let's assume that your marginal tax rate is 20%. So $150,000, 20% of that will be $30,000. So $120,000 that is left plus the other $150,000, the total $270,000 is yours to keep. That's how it works. Now, some people don't want to sell houses, but they want to move into another one. There is a way you can work around that. You don't have to sell. And you want to move into another home and then convert the house that you are currently living in as a rental property because you are moving into another house. What you do in that instance is there will be an appraisal that is done. They will determine what the market value of that property is at that point in time. And that is what CRA, we assume, as the actual cost basis for that property going into the future for tax purposes. So using the same example, I bought the property at $500,000. It's now at $800,000, but I want to move into another house. CRA does appraisal and they say the property is at $800,000. For CRA purposes, $800,000 is the property that you bought that house. Any gain above and beyond $800,000 is what is now taxable for tax computation process. I hope that helps that person that answers that, that asked that question.
Very, very helpful. But obviously, as we can see, this whole process can be quite technical and people are already asking for your contact details. So for those of you who want to still ask more questions, as I'm sure you all do, I myself have some questions I want to ask based on what has been shared. You can contact Frank and Bisi with the details that are up on the screen. Their email addresses are there. Their phone numbers are there as well. So I want to ask the both of you as last questions before we go. Bisi, can you just give us an idea of what pre-construction is about? This is a question from Peace.
Pre-construction is just the word, pre-construction. You want to buy a property before they construct it. So a builder tells you, I want to build in this particular location, and then this is the amount that the property is going to cost when it is ready. However, for you to own it, you want to put some money down. It's something like a down payment as well. So I'm putting money down on this property for a social number of time that this is going to happen. We've seen a lot of pre-construction coming. Over the next 2 years, there will be a lot of supply coming from, newly built properties. Still won't be enough, but it's a good step in the right direction. So builders, when they want to build, you are relying on the fact that the builder gives you the award that they are going to deliver as at the time when they say they are going to deliver. In most cases, it's slightly beyond that time. So they either ask you to contribute between 5 and 15% is what I'm seeing. A lot of people are staying at that 15% now. Before, I did a pre-construction last year. I only did maybe about 8%. So the builder decides between 5% and 15% where they want to be. Most times is now at that point. If you have the cash, buy it. Because what that means is that the moment you put that money down, as long as that property is going to be ready, it is a lot going to be more in value when it's ready. Why? You have put money down into the future, you lock in the rates today. The rates doesn't change tomorrow. And then you find that appreciation in the market is going, by the time your property is ready, it's also going. There is a risk to it though. And the risk is, if when the time comes for you to complete the mortgage funding, you don't qualify for funding, then that can be a big challenge. But I don't see that mostly happening. And that's the reason why you see some builders, they will put what we call assignment clause in their process, so that if you can't meet up with the funding, you can assign that property to someone else by selling it at whatever price you guys agree on, and then you can move on with whatever gain that you get there. But we can talk more about this in another session. I'll be happy to have this kind of. Thank you guys.
Absolutely. Any final word from you?
No, so Nanda, I think firstly, just to say again, thank you. I think it's been a pleasure sharing with everyone. I see the questions coming in, and it's funny because these are typical questions we get each time we interact with people. I think the essence of this is to keep driving conversations. Let's ask questions. There's so many things happening in the industry. The industry is ever evolving. There's so many nuances to mortgage, and no two files are ever the same. So please feel free, ask as many questions as you want. Our details are up there. Kindly reach out. I want to call out one thing as well to say, part of the reason, or one of the major reasons why we do this is not necessarily so we appreciate the business, but more importantly, we appreciate the impact we're able to make. It's about being able to make the impact. So even if you're working with a different mortgage agent, but you have a question and you just feel, you know what, I think I can ask Frank this question, please shoot me a text, shoot me an email. I'll be happy to answer you, even if you're not working with me, even if I'm not handling that business. It's about being able to help one another grow. It's about being able to enrich our lives. It's about being able to support and get the right knowledge that you need to make this happen. Yeah, but hey, thank you so much, Nandi, and thank you so much, NCA.
Thank you so very much to you, Frank. Thank you very much to you, Bisi. Obviously, 1 hour is never enough for this kind of session. I never anticipated that we'll be able to go through the questions. Thank you for joining us. Thank you to our facilitators. If you want to see the content we've just shared within the next 48 hours, it should be up on our social media platforms, which we have on the screen. And also, like we shared earlier, if you have more questions for Frank or Bisi, please feel free to reach out to them. These are their phone numbers and email addresses. Their contact details will also be available on our platforms so that you can reach out to them as well. Thank you so much, everyone, for joining us today. Do have a wonderful rest of the day.